Welcome back, guys. You liked my last reaction video on Trader Tom. Definitely make sure to check it out. So today another one, and I want to react on the ICT concepts. So I always heard of the ICT, of the inner circle trader. Here's like his YouTube channel with 1.4 million subscribers. It's insane. And we're gonna react on the ICT concept explained in 12 minutes. I think that's quite a short time. It's Casper's YouTube video, so we're gonna check it out, see if I can learn something. And to be honest with you, I really do not know anything about those ICT concepts yet. I never wanted to learn it. I have my own strategy, but I want to see if my strategy somehow matches with some concepts. So let's check it out. Maybe you can learn something as well.
Look, over the last few years, I have spent hundreds, and I mean literally hundreds of hours watching ICT's content. And throughout my journey, there were so many times that I would have killed if I could just have a simplified overview of what to actually use from ICT's concepts.
Yes, and this is what we want to have. A simplified overview, so this video will be perfect.
If somebody would have just put together a simplified guide of what actually matters and what you need to use day to day in trading, I would have been able to become successful so much faster. So that's why I made this video. And I'm going to explain everything that actually matters in ICT in under 13 minutes so you can focus on what actually
Sounds good,
matters,
so let's get right into it.
The concepts into your trading. But enough of the chit chat, let's hop on a chart.
First on our list is price.
Okay, so everybody is talking about success, and ICT seems to work pretty good. Otherwise, it would just be like some people catching clickbaity stuff, but I don't think clickbaity stuff is worth 1.5 million subscribers. So I, in the end, have to come to the conclusion that it should work. So let's see if we can learn something here for our trading.
Price. And the first section of price is going to be liquidity. Something you always have to remember is that price is always moving towards liquidity. Whether it is moving towards internal liquidity, like a fair value gap, which is the gap between a wick candle that has a big body, and then there's a gap between that candle's wick.
Okay, first of all, it seems to be very technical. So technical strategy, chart-wise, chart analysis, technical analysis. I actually did not know that it's just technical. It could have been fundamental as well, but seems like we really are getting way into the depth of the technical analysis. As you can see, he's really counting the candle wicks and the difference in space between the high of this candle wick and the low of this wick. So actually, that's very precise.
Wick and the candle after its wick, that's a fair value gap, and that is also called internal range liquidity. External range liquidity can be any high or low, meaning any candle that has a higher low on either side if it's a low, or any candle that has a lower high on either side if it is a high. So that is going to be external range liquidity, any highs or lows. So the market is always going to travel from internal range liquidity or fair value gaps to external range liquidity. When the market hits external range liquidity, you can look for the market to come back down to internal range liquidity. So next, we're going to talk about time-based liquidity.
Okay, so it seems like that this video is very, very informational, but also quite hard to follow the first time you watch it. So I try to get as much information as possible here, and I try to memorize as much as possible and to comment on as many things. But bear with me that I'm watching this for the first time here, and it doesn't seem to be that easy to really comprehend everything that he's saying the first time.
Time-based liquidity is the high or a low of a specific range in time. For this example, we're going to be using a daily candle, so the previous day's high or the previous day's low. You can watch how price interacts with these levels to see what the current bias is. For example, if the market pushes under the previous daily low and it does not close beyond it, then it's likely to go to the previous daily high. Next, we're going to talk about market maker.
Okay, so those are the specific rules. He's just basically listing all of the rules with liquidity, highs and lows, candle wicks, stuff like that. So you could very well pick a piece of paper and write down all the rules and try to find them in charts. But I want to really see if I do something similar maybe in my trading. So let's continue watching. Until now, not really.
Section 2 of price is market structure. First, we're going to talk about your impulse structure. So as the market is pushing very abruptly, like we form a low here and we have a big move to the upside, that is going to be an impulse. So we expect the market to continue through these impulses. Now, let's say if we have an...
Okay, so basically, as far as I'm getting it right now, it's just a form of a technical analysis and a strategy based on chart techniques. Okay, so far so good. If it works, it also seems to be still quite individual. So I really have to find those indicators, those liquidity gap, stuff like that in my opened chart, and then have to make my trading decision. Okay. So I am not able to either trade based off my intuition, and I'm not able to have fixed rules that always tell me in which direction to trade now.
Next, we're going to talk about manipulation and displacement, and this is how you make sure you're drawing the proper market structure. Notice how in this example up here, the market barely tapped up above this high. So we look at that as a manipulation because it didn't really push through. Now, if we look right here, that's going to be a displacement because the market pushed an energetic leg through that low. So that
Okay, it's basically just talking about a fake out. I would call it a fake out in a 15-minute chart here. So market made new highs, but was not able to really trade above those prices longer. Basically sold off immediately. For me, a fake out and a short signal.
that displacement, we're expecting for the market to continue. So anytime we have a displacement, we're going to expect a retrace, often into internal range liquidity, like we talked about, and then the market is going to go where? Down to external range liquidity. See how you can pair these concepts together to get higher probability setups. And if we look over here, the market is failing to displace or manipulate concepts.
Okay, so now this internal range liquidity and external range liquidity. Basically, it's a structure point. So this here is a structural low that was broken in this 50-minute candle, maybe even with some unfinished or very fast so-called bad auctions not being equalized yet. So we have a lot in the, if you take a look at the footprint chart at the order flow, you would see a lot of one-way auctions, which means that in such a footprint candle, only one side of the market participants was able to trade, and on the other hand, always 0 contracts have been traded. So this is a one-way auction that at most occasions needs to be equalized. So I would look at that. If I would see such a big fast candle, I would take a look if there are some one-way auctions that maybe need to be equalized, and then of course this little pullback, this little equalization could take place. Where does it end? Pretty much here at this low of this candle's wick, so at this lower structure point, at this previous support that now became resistance. So he basically just trading support and resistance right here, calling it internal range liquidity, and then he's taking a look at the overall lows, calling it external range liquidity. That's basically like 101 technical analysis that everybody knows, okay? So basically not that difficult, but interesting to see how he calls it.
Together to get higher probability setups. And if we look over here, the market is failing to displace or manipulating this low, and then it pops up and displaces through this high. So that tells us the market is bullish, because if we displace, we're going to get follow through. And if we're manipulating lows, then the market is likely bullish. Next, we're going to talk about S going to get.
Okay, here as well, he's calling it all those fancy words. In the end, we just get a breakout of the range. I would call this just a basic range. We get a breakout. I would trade it as it is. First of all, I would try to short the top of the range. That's my strategy. And if I see prices that are closing above the top of the range, I would immediately reverse my position long, take the little loss that I got, and then try to trade higher prices, okay? So it's basically just a breakout of the range and then even a retest. So we break out, are retesting this structural point here, the structural high, previous resistance, now support, and then make higher prices, okay? For me, nothing new.
And if we're manipulating lows, then the market is likely bullish. Next, we're going to talk about SMT divergence.
Again, and he's also referring to this fake out here at the lows as a manipulated low. Okay, I would see fake out, but in my experience, okay, he's on a 15-minute chart. Maybe it's not that often on a 15-minute, but on a 5-minute, you can see those fake outs like every hour or so. And sometimes they matter and sometimes they don't.
And if we're manipulating lows, then the market is likely bullish. Next, we're going to talk about SMT divergence. So SMT divergence is whenever assets that are correlating aren't correlating, right? So for example, the S&P, which is what we have on the left, and the NASDAQ, which is what we have on the right, they should be making the same structure. But you see here in this example, ES made a lower low while NASDAQ made a higher high.
Also completely nothing new. To me, it's just a negative correlation between the NASDAQ and the S&P. Nothing big. Sometimes people are trading those divergences with some indicators like S&P 500 with the RSI or the stochastics indicator, okay? And then try to find those divergences. In this case, he's just looking at the correlation between NASDAQ and S&P 500. I would rather do that in Bookmap, for example, and you can really implement a NASDAQ indicator in your S&P 500 heat map, and then you would see, okay, we're building, oh, let me draw that for you. In Bookmap, you would be able to see some bubbles, maybe some absorptions here, okay, higher bubbles. And in the NASDAQ, you would see lower bubbles, and then we could identify perfect divergence in the S&P 500 and the NASDAQ. Does this divergence help you? Maybe, but also the question will be, okay, which one is the leading market? Are you now have to go short in the S&P because the NASDAQ is the leading market? Or do you have to go long in the NASDAQ because the S&P is the leading market? I don't know. So maybe he's talking about that now.
High. So this would be a bullish SMT divergence. Now, if it were the flip side and one was making a lower high, then the other one was making a higher high, that would be a bearish SMT divergence. The best way to use
Okay, he just told us basically that the S&P was the leading market here. This one would be a bearish divergence.
and the other one
Here in this case, this would be a bearish divergence for him. Of course, now as we can see how the market turns out, we can definitely say that it's bearish, but there are enough examples where the NASDAQ is the leading market, and if the NASDAQ is making those higher highs and higher lows, and the S&P does not do that, the NASDAQ will lead the S&P finally to higher price and not the other way around. So for me, this is not the indicator that tells me in which direction to trade here.
bearish SMT divergence. The best way to use SMT divergence is when you're trying to find the low of a day, a week, or a session. The next section of ICT we're going to talk about is order flow. So the market is always going to be delivering towards one side of the market. So the way we determine which way the market is delivering is by a combination of some of the stuff we've just talked about: manipulation, displacement, and internal to external. So for example, if we see the market is manipulating lows and then we're displacing to the upside, well, we know that if the market takes out external range liquidity, we're likely to get a continuation and push to the upside. Now, the way we can confirm this are when down close candles start getting engulfed by up close candles. This creates what we call an order block. These levels can be looked at as support as long as the market is still bullish, and we can also pair it with other concepts like whenever we're taking out a low.
Okay, I don't want to talk bad about this approach. It seems to work very good, and it's way more detailed than my basic concepts, and I would need to really backtest those concepts over years of data. But for me, it's just like intuition and basic stuff. I would not look at the detailed candle wicks here, but for example, he's talking about the fake out here where the market traded this external range liquidity. Okay, again, it's a 15-minute, but such a wick where the market is taking out liquidity to one side basically happens so often. Yeah, it's for me no indicator here that something is about to happen. And he's talking about an order block. And from my point of view, that's just accumulation in an ongoing long trend. So we basically break out of those resistances here, making higher highs, then have some accumulation, some liquidity building up. Maybe in Bookmap you would see many absorptions here at the top, and then a breakout out of those absorptions, out of this accumulation, and still ongoing trend.
And
nothing too fancy here.
To display.
But I'm not trading it like that, okay? I'm not trading with Bookmap at all currently, okay? I have my basic rules. Again, how I would trade this scenario, I don't know what happened before. Also look at the timestamp here, okay? He's basically, I don't know which time it is, but in 1:30 at night, okay? Do you really trade there? I doubt it actually. So basically, it's nice to find those perfect examples for ICT, but 3 o'clock in the night, nah, come on. Okay, but if this were regular trading hours, I don't know how the market turns out, if this is a trend or range, but I would start off with a range again, try to short the tops of the range, get stopped out here as the market is breaking higher, making new highs, and I would immediately reverse long. Then I would see a retracement of 2 consecutive bearish candle. That would be an indicator for me to move the stop loss from somewhere all the way down here below, underneath this little finished retracement after we made new highs. The stop loss would not be taken out. We actually are going higher. Here we can see, hopefully you can see it, it's a little dark up here, but we can see single retracement bars. This is not an indicator for me. Only after at least 2 consecutive counter trend bars I would maybe think of moving the stop loss again, and after the new highs were taken out, this would be the indicator that this is the finished retracement here, and I would move the stop loss again upwards, having a new one, and I would continue like that until some candle is closing underneath my stop loss line, and then I would know that this position needs to be closed, so I would just move the stop loss upwards with the trend. This is how I would trade. It's completely different from him, but
and we can also
maybe it's interesting for you.
It with other concepts like whenever we're taking out a low and failing to displace, and we are already looking for the market to be bullish anyways. So a trick you can use is if you are bullish, you should see down close candles quickly engulfed by up close candles. Now another trick you can use is as long as candles are closing beyond the previous candle's wick, then the market is still going to be bullish. So when the market is bullish and we're engulfing these down close candles to the upside after taking liquidity, that is going to be called a change in the state of delivery, or a CISD. So in this example, we took out a set of equal highs. Now something else I want you to pay attention to is that these were also time-based. This was the previous daily high. And like we said, if the market is failing to displace above the previous daily high, the draw on liquidity, or the target, is likely to be that previous daily low. So on the higher time frame, this is what it looked like. Draw on liquidity.
Let me watch that again here for a second.
If the market is failing to displace above the previous daily high, the draw on liquidity, or the target, is likely to be that previous daily low. So on the higher time frame, this is what it looked like. Just like that example, we talked about time-based liquidity. The market failed to close beyond that low. So then you can hop into the lower time frames and look for a change in the state of delivery. So anytime this up close candle.
Okay, I don't get this point. Maybe I'm just wrong, but he tells us if the market is not able to close. Let me get that real quick so I'm not talking bullshit here.
Frame, this is what the draw on liquidity, or the target, is likely to be that previous daily low. So on the higher time frame, this is what it looked like. Just like that example, we talked about time-based liquidity. The market failed to close beyond that low.
Market failed to close beyond that low. Well, he's looking at the daily candle. So this candle only closes at the end of the day. So how does he want to make a trading decision based off this daily candle if he wants to look at the close of it? So basically he cannot trade on this day if he's waiting for the daily close. And he's telling us the candle is not able to close beyond this high. So therefore, as it's trading lower, he gets ready to wait for a push to the daily low. Okay, could be. I don't know. So the first sentence did not make any sense to me. Maybe I'm just wrong here. Maybe I quite didn't get it here. I'm watching this for the first time. But yeah, waiting for the close of this candle basically is not possible. So in my opinion, if this candle is still going short here and had this little fake out here, that does not mean that it's not able to push higher again. Maybe I'm wrong.
Then you can hop into the lower time frame.
So let me scroll a little bit through examples, entry models. Okay, let's take a look at order blocks for a second.
And let's say if you're bullish, what you want to see is a manipulation, and where we sweep out all this liquidity, and then a reversal under that time-based liquidity and push to the upside, okay? So these reversals right here are where you're likely to see SMT, and it makes a higher probability if it's trading into a fair value gap or an order block, or really any key level.
So basically ICT collects every possible technical and liquidity-based indicator, or technical or liquidity-based information, and puts it together in one system, and you basically have to watch out for everything at once. I think could be tricky. Okay, I'm telling you what I think about it later, but
now on top of that,
take a look at some examples here.
If we look at the market, if you're talking about internal range liquidity to external, well, this is the exact same example that I gave you earlier. So
again, to me, look how he's drawing his internal range liquidity. So for me, this liquidity would not be here so much. I would find a support level here, where this big engulfing candle engulfed various previous bullish candles. It's a daily, okay, crazy. And I would then say, okay, this is maybe a new support level. And we can see the market pushed through and it acted as resistance real quick here. Market pushed long again. So it was more or less a fake out here of this structural point. But then it became valid again as support for this trade here. So I would find my entries here and not what he is talking about, just because it's a little gap between this candle wick and this one. I could be wrong. Maybe it works better than I think it does. But
seeing how you can pair
for me, it's just support resistance.
All of these things together in order to get high probability setups. Or you could have used just what we talked about a second ago, which is the change in the state of delivery. So as soon as we engulf that down close candle, you see that the market never turned back. And when we traded into it, it could have been used as support. Or you could have used displacement, right? That's another way to do it. The market is displacing through this high. We're coming back.
Okay, let's watch some entry models.
This entire video. And I also have a specific video that's all about bias. I'll go ahead and throw a card up to that on the screen. But anytime that you're looking to frame an entry, you need to use the higher time frame to build your lower time frame bias. That's what ICT is all about. So in this example, we took out that previous high. As soon as the market closed under this candle right here, you can literally just execute.
And he's again showing the same examples, okay?
as soon as that happens,
Just want to
which
mention
would
that.
give you a little
And I'm
bit
not judging him by any means. He's just explaining the ICT models, and I think he does a great job with it. So definitely a great video. I'm not judging him by any means. He's just explaining the ICT concepts here, and it's a very good video. Definitely let me immediately give a like on the video. It's a great video with great explanation in a very short amount of time. So if I even judge anything, I would judge the concepts of ICT and not him by any means. Okay, let me just make that clear.
Reward, you can put your stop above that candle and target out the overall draw on liquidity. Now, that is one way to do it. And you always want to make sure you're getting a minimum of 2R. Don't get too crazy with it. Don't shoot for 10R or any of these huge targets. But as long as you're getting 2R, you're good. So the key is going to be.
So again, he now tells us that we definitely should trade with a fixed risk reward and at least go to the 2-to-1 reward risk ratio, okay? So that's completely against everything we watched in the last video where Trader Tom really captured a beautiful trend day and added aggressively throughout the trend and never had a risk reward or anything like it, okay? So completely different approach here, as we can see. And I'm not trading with risk reward either, so it's also not what I would do here.
Waiting for a reversal framed around time-based liquidity, framed at the proper time. So what you want to see is whenever your lower time frame bias aligns with your higher time frame bias, okay? In this example, you're taking out the previous daily high on a week that you were bearish, and you're starting to put in a change in the state of delivery. So this is the way you can
look at that. What I would do here, as you can see, this day starts off somewhere here. Here's the 20th, okay? So those are many different days here in the 15-minute. And keep in mind, this is the 15-minute, okay? So I would only trade on a 5-minute. But in this case, when the US Open, I don't know where it is, seems like he's in US time. So basically US Open could be somewhere here maybe. Okay, I would first, and this would be a bad day for me, okay? I would maybe even lose some money on this day. I would first of all try to short the tops here if the market should open below. I don't know where the US Open is precisely. It could also be that the US Open is somewhere up here. I would try to short the tops here again. It would not work out. I would get stopped out. I would try to go long and maybe have the opportunity to move the stop loss now underneath this structural point. So at some point here, I would get stopped out for the second time and then would go short again, maybe here, and would take this beautiful short push lower completely without risk reward ratio. Okay, I would just try to profit as much as possible from this huge short push. And I don't know if I would go out with profit or a little loss here on this day, but that's what I would do here.
Enter the market just now. It's an close if you'd like, and you can target out the draw on liquidity.
So let me check out what he is trading here.
Level was just a 15-minute fair value gap, and you are sweeping out liquidity and failing to displace. Then you can go to the lower time.
Where is his fair value gap?
Fair value gap. That is a bonus. Now on this for entry models. So as we said before, if you're trading into a higher time frame key level, that is a bonus. Now on this example, the higher time frame key level was just a 15-minute fair value gap, and you are sweeping out liquidity and failing to displace. Then you
I'm not quite sure where the fair value gap is here. As probably I'm completely wrong. Is he talking about this internal range? Maybe. I'm not quite sure here. Maybe I'm just not good enough here after just 10 minutes of watching this video, but okay.
You can go to the lower time frames and look for a market structure shift. So in this example, the market structure shifted up. And again, you can just mark it on.
Okay, I think I would never trade this. I really wouldn't. Okay, there are some points we can talk about, like a fake out here out of this range that previously held the support level. But this is not a market shift for me just because we made a little retracement and new highs. A market shift only occurs after, I would say, the earliest possible way would be if the last two structure points would be broken. Okay, if we're talking about a possible long entry after this push, I would previously look at the finished lower highs. Okay, so this is the first lower high and we got a lower low. I think that would be the second latest lower high and lower low. So I would, again, the earliest entry I would search for a long push would be up here. Okay, maybe if this candle, I don't know if you're able to see it, maybe if this candle closed here above this lower high, then I would maybe think, okay, maybe market structure change, but try to trade market structure changes after such a little push to get stopped out almost every time. Maybe he has several other indicators that are allowing him to go long here, but this is not a market structure change for me. Okay, that could be anything here, especially in the, is he in the 1 minute? Is he serious in the 1 minute? Okay, crazy.
On this close if you'd like, and you can target out the.
So I'm not judging him by any means, he's just explaining the ICT concepts, but for me now this is basically a collection of everything you can try to find in a technical analysis chart. Everything you can ever find here is collected in the ICT concepts, and you basically have to look out for anything or everything to find your entry. Again, this is a 10-minute video. To get really into ICT, you probably need weeks or months into practice, but for me, this did not really convince me to do that. Okay, I found this video again from Casper, where he is like showing 3 best trading strategies with ICT. Maybe I just want to take a brief look into it.
If we zoom in right here, we have a fair value gap. Now,
okay, again, the fair value gaps.
Fair value gap?
For me, fair value gap would be just previous support that now became resistance, okay?
Anytime that we have a gap where a big candle has no wicks on the side of it. So notice how we look right here, there is a gap between this candle. Well, that is a good signal that the market is bearish. So as soon as the market closes below with this candle right here, right, we close below that fair value gap. At that time, you can enter the trade and put your stop loss above the highest high. And then
yeah, maybe it's working, guys. Maybe it's working. I don't know. Definitely leave me a comment down below if you are trading ICT and if you are successful with it. I would really need to know. I think it's a very interesting topic, and I would really want to see some authentic reviews from small retail traders like you and me if this is working. Okay, and maybe write down how long are you trying it, how long are you learning those techniques, and if you are successful with it or no. You can be completely honest. This is a so-called safe haven for us traders. Okay, this is a complete safe space. You can be honest. It really doesn't matter if somebody is profitable or not here. This is a safe space. Okay, that was interesting to me. I definitely got the first look into ICT concepts. I never watched a video on it. I always heard from some traders telling me that ICT is the hottest shit. Okay, so be it. For me, it's just a collection of different technical analysis strategies. Basically, you have to look up for everything you can ever find. That's my first few. Great videos by Casper. Definitely give him props. All the videos are linked in the description. Also, a link to Inner Circle Trader is in the description below. Thank you guys for watching. Write down in the comments what I should watch next, what I should react on. Leave a like, comment down below. We see us next time. Take care of yourself, guys. Bye-bye.